This is Robert Kraft, and I'm your host on the Planet MicroCap Podcast. And with me today is a very, very special guest. He was actually my guest for episode 1 of the Planet MicroCap Podcast. He is the founder and editor of MicroCapClub.com, the inimitable Ian Cassel. Ian, welcome back.
Thanks, Bobby. It's great to be back. I think it's been, 4 years since episode 1?
It's been 4 years. And you know what? In that time, I learned how to say inimitable. That was only the third time I've ever said that.
It's a big word.
It's a lot of syllables, I's, they're all over the place. But, Ian, I wanted to say before we got started, just really thank you so much for your support of this podcast. You've been, very helpful both, in front of the screen and behind the scenes with helping me and getting some guests and really just so thankful for all your help with this endeavor. So, I just wanted to make sure that you knew, and I'm very thankful for that.
No, thank you for what you do for the space. I mean, I enjoy listening to the podcast. I think there's very few venues too that kind of bring emerging managers, specifically in microcap, give them some needed exposure. And I think you do a great job with that as well. So I appreciate you shining a positive light on this ecosystem.
Thank you. And then, all right, before we everybody clicks away to because we're heaping so much praise on each other, let's get started here. As you said, last time you were on the podcast was back in July 2015. But first, before we get into an update and how things may have changed in your life and investing style, let's give everybody a brief background as to who you are and how you got started with MicroCap Club.
Sure. So my abbreviated background was I got interested in investing when I was a teenager. When I was a junior in high school, my parents had saved for me an amount of capital. They said, this is going to be what you're going to get for college. This is all you're going to get. And so they gave me that choice at that point in time to where I wanted to go. And so I ended up, this was 1997. That sounds like a long time ago, which it was. 1997 technology bubble, bull market era. Everybody was investing in tech. And I got interested in investing back then, invested into some small cap technology companies that ultimately went up 3 or 4 or 5x, because you could throw a dart and had those types of returns during that time period. But when that bubble collapsed, all those investments I was in got smaller and smaller and smaller. And maybe it was because those investments turned into microcap, a couple of them. But I started looking at smaller and smaller equities at that point in time. And I ended up getting into microcap investing, which would have been, when I was in maybe a sophomore in college. So, that type of time frame. And so really from there, just kind of learned the ropes of microcap investing from losing my money and gaining it back, losing money, had a few mentors. Back in mid 2000s, everybody was on stock message boards because these small microcaps, they're mainly owned by retail investors, and those retail investors tended to have an audience on public message boards, and so kind of built a reputation on there, and went from undergrad into grad school, and formed my own little consulting company for a little while to kind of buy my time to become a full-time private investor, which I did in late 2008. During the economic crisis. That's when I kind of cut the cord of income, decided to go full time. Obviously looking back, it looks like the best time ever, but it was a scary time, to make that decision.
I mean, what a timing still. I mean, I've heard you do, listen, I've interviewed you. I heard your interview with Tobias and a few other interviews you do. And each time you say that point, I'm always just like, man, what a jump at that time.
Yeah. So, ultimately, the 2008 became a full-time private investor. Had my own blog for a while where I would talk about what I liked and why. I've always been really concentrated as an investor in 4 or 5 names at that point in time. And so it was just kind of talking about those 4 or 5 names, kind of build up an audience on there, almost too much of an audience, and decided to shut it down because everything I was posted on would move the markets and it wasn't the type of exposure I wanted to get. So kind of shut that down for a while and started thinking about, I love talking about what I own and the microcaps that I'm looking at. And I was always interested in what other experienced microcap investors liked and why as well. And so in 2011, launched MicroCap Club, sort of a private community of microcap investors. So really what we do is just share what we like and why. And so that launched in 2011. Today we have around 200 members. We have a few hundred subscribers as well from around the world. And it's really just meant to be an idea generator for microcap investing. It's meant to find your peers, people just like you. You can collaborate on due diligence into companies. And, since 2011, we have 650 microcap companies profiled on MicroCap Club, which is a big swath of companies. And we also have an annual event we put on in Chicago every year called the MicroCap Leadership Summit, which we can get into later. But that's really kind of points me up to where we were at 2015 when we had our first initial episode 1 of this podcast.
Oh yeah. And before we get into that update, because MicroCap Club is now a known entity. I'd say even amongst institutions, amongst issuers, a good amount of these companies now know about this club and whatnot. One question I always get asked actually by issuers and CEOs sometimes is like, well, what kind of companies are talked about in here? What it seems to be their focus. I mean, you've been running this since the beginning. You started this. What would you say tends to be if you had to kind of paint it with a broad stroke, what are some of the types of companies that usually get written up or talked about on there?
I would say it's mainly the smaller half of the microcap ecosystem. That's probably our sweet spot. So sub 150 million market cap. Mm-hmm. We have US, Canadian microcaps. We're starting to get more into the UK and Australia as well. But it's predominantly those geographies, and the types of companies can range from companies that are growing, profitable, great businesses, to story stocks, to life science companies, to mining companies. You kind of have every itch that's scratched on MicroCap Club. Because really, microcap investing is just like kind of small cap, mid cap, large cap. You have all those types of businesses that are smaller.
Right.
And so it really is a lot of different types of companies, but predominantly the smaller half of the microcap ecosystem.
Gotcha. All right. So now we're going to get into that update. Last time, again, I had you on July 2015. A lot has changed for you both personally and professionally. So let's get that update. What have you been up to since then?
Well, I think we did our podcast July of 2015, and I think I had my daughter the month after that. So now I have a 4-year-old daughter, and now we have a 20-month-old son, Jack, as well. So so now there's 2 kids running around the house, so that adds complexity to your schedule and everything like that. But it's been a great experience. When you think about microcap investing, if you invest in microcaps, you should be somewhat ready to have children, because it's there's a lot of correlations between young kids and microcaps. It's similar to young kids. You don't let your 3-year-old in your house by themselves, because they probably burn the house down. It's the same thing with microcap investing. You need to watch your microcaps closely. I'd like to think that I was prepared for fatherhood, maybe because of microcaps, but maybe that's a stretch. So I'm now a father.
We'll let everybody else decide that one. Yeah.
Yeah. So now, in addition, maybe the other thing is I launched a small investment strategy earlier in 2019, just because I've been asked by investors almost every year, could you help manage some capital in this small microcap ecosystem? And they wanted some intelligent exposure to this ecosystem. So maybe 2 years ago, started thinking about how to do that, how to structure it correctly. And so launched Intelligent Fanatics Capital Management in May of this year, and brought in a few investors into that. So in addition to my personal investing, helping manage about 40 other investors right now, navigate them and get them exposure into this ecosystem as well.
Got it. And I know you talked a little bit about it on Tobias's podcast as well, but can you give us a little bit about the philosophy and the strategy for, I'm using the acronym IFCM?
Sure. Yeah. So, the pitch, I don't need to give you the pitch on microcap investing. What I'll do is give you a pitch on why it's hard for people that aren't in microcap to gain exposure to it easily, is because, if an outside investor wants to gain exposure to microcap, they're kind of forced to buy the iShares microcap ETF, or they're forced to buy maybe 20 other open-ended funds that are out there. And the issue with that is those funds are predominantly all investing in the larger half of the microcap ecosystem, sort of that 150 million to 300 million plus swath of market cap. And those are sort of the institutionalized microcaps that are out there. And you can do well in there, but there's very few ways for you to gain intelligent exposure into the smaller half of the microcap ecosystem. And why that's important is there's a few studies that were done. In fact, one of our members of MicroCap Club looked at all the CSRB data going back to 1926, and the smallest decile of the public markets outperformed all the other deciles. So the smallest decile is sub 114 million. And that outperformed every other market cap decile by a wide margin. And so you have some historical data that backs up that the smaller half is the place to be. And then there's also some white papers you can find from Roger Ibbotson, who's done some work on illiquidity. And to drill down further, he's kind of showed that since 1971, the best place to invest is basically illiquid microcap companies. And so you have this historical evidence that's pointing to, hey, the best place to be in the public ecosystem are these small illiquid public microcap companies. It's just hard to invest in there, and not very many active managers do it because it's not a scalable fund. You can't put $200 million easily into the smaller half of the microcap ecosystem and at least be in 20 or 30 names. It's just impossible. So the strategy I launched, it's kind of unique because it's capacity constrained. I went out to bring in around $5 million, and we hit that in a few months. And it's not something that I'm actively out there bringing capital in. It's just because it sort of ruins the potential for alpha as you bring more and more capital into it. But that's the opportunity set, for IFCM kind of in this smaller realm, and that's why I launched it.
Cool. Well, with the launch of IFCM, becoming a father twice over, how would you say that your investment process or your strategy has changed? Since 2008 and even since 2015. I'm sure you've had a nice evolution since then.
Yeah, it's a great question, and I've spent some time reflecting on that in a couple blog posts that I've written maybe in the last 12 months. But when I think about it, I'm definitely more diversified than I was, call it in 2008, 2009, and the years before that. I was historically in 3, 4, 5 companies, which is obviously very concentrated. That's how I kind of grew a net worth up to a size that I could support myself and my family. But I've tended to evolve that. Instead of being in the 3 to 5 names, I'm more into that 8 to 10 type companies, which anybody would say is still concentrated, but it's more diversified than how I was before. And maybe another way that I've evolved is I think I have a shorter leash for losers in the portfolio. So companies that aren't performing. I think it was Phil Fisher that had a rule that he had a 3-year rule. If he wasn't up on his investment in 3 years, he would just cut it loose. And I think that's an interesting way you can kind of protect yourself from yourself a little bit. And, I would say maybe mine's even shorter than that. Maybe it's 2 years. But I've made some mistakes in the past where I've held on to things too long. And so I think that's where I've evolved, is actually having a shorter leash with some of the companies. Maybe another way that kind of my strategy has changed is, there's been some times where I've kind of gotten away from some of the areas where I made money in the past. And maybe the portfolio has gotten a little stale, so to speak. And so I've kind of injected some of my past experience more into it, so where there's some different buckets in the portfolio of companies that I have experience in. Like, for example, maybe I have some more like story stock type companies in there. Maybe I have some mining related companies in there, which I have some experience there as well, where maybe 3, 4 years ago it looked like just a bunch of GARP companies and really no other optionality there other than those names. And so I've kind of brought those things back into my portfolio, or the arsenal that I have. And maybe the last thing I can think of off the top of my head is I've started looking internationally. Outside of just the United States and Canada. I've started looking at the UK, the AIM exchange, started looking at some Australian microcaps as well. And, that's mainly just been through brute force, kind of just going A through Z and trying to find some interesting companies over there. And one of the reasons I did so is because I was stumbling upon companies first on the AIM exchange that they're still going public as small companies, which isn't happening as much here in the United States.
Unfortunately,
they're actually bringing companies public, IPOing them on the AIM exchange, doing a $10 or $20 million small IPO, and they're not just all life science companies needing to raise money for a phase 1 trial. They're actually real businesses. And so that attracted me there. And some of them that they did that in 16, 17, some of them went up 10, 20x, in the last 3 or 4 years. So that kind of caught my attention, and it made me kind of want to focus over the UK and start to find maybe some unique businesses over there, and also doing the same thing in Australia as well. So I think I've become a little bit more of an international microcap investor over the last really 2-3 years, more so than I was in the past.
So I have a few follow-ups on how you've changed up your style and your strategy. Let's hit on that globalization, because we've been seeing the same thing too, kind of seeing that where, there's less quality companies going public earlier in their life cycles here in the US. It's almost kind of forced investors to look abroad, right? I mean, was that kind of the impetus for you?
I think so. I mean, it's really interesting. Like in the UK, you'll see a small microcap go public. It's a real business, and you'll see like BlackRock be a part of the IPO, which is just strange. It's like you would never see that in the United States. I just don't understand. It's something I still don't really know why. I wish we had that over here. But yeah, I mean, it just forced me to start looking outside the geography. And I think there's plenty of opportunity here in the United States, even with less companies going public. And you don't want to get too far out of your core competency. But I also think there's blatant opportunity in other markets, and you would be kind of foolish not to at least start to educate yourselves on those areas.
Well, look, I mean, there's just three regions off the top of my head that are also English speaking regions. You have UK, Australia, Canada. I mean, well, there's a little French up there, but for the most part, English.
Yeah.
So it's,
exactly.
So it's easily accessible.
And a few of the management calls I've had with companies abroad, I was the first United States investor that ever reached out to them. It kind of feels like 2012 when very few United States investors would look at Canada, previous to 2012. And now everybody in the United States invests in Canadian microcaps, and so
everybody.
It feels a little, pretty much. I mean, nobody did pre-2012, and then all of a sudden now it's hard to find. I mean, everybody seems to be investing in Canadian microcaps, and that's great. But you kind of have that similar type of setup, it feels, in some of these other geographies. So it makes it interesting.
For sure. I think we can thank our friends at Small Cap Discoveries for helping lead that charge. That's for sure.
Absolutely. Thanks to Paul, he's made the markets much more efficient up there.
For sure. So another thing I wanted to hit on that you said when you changed up your strategy a little bit is this idea of having a shorter leash. I mean, when you're looking at a company, you're evaluating it and wanting it to bring it on into your portfolio. I mean, I'm sure that leash isn't as disciplined as what, the Phil Fisher, if I don't see it after 3 years, but at what point in your thesis for a company are you telling yourself, okay, is it when management continues to tell you that they're going to perform and don't hit those milestones? Or is it more like, they do keep saying and doing what they're going to do, but it just hasn't turned yet. Why? What seems to be that turn for you when you evaluate each company in your portfolio?
I think it comes back to your first point that you made about when you have a management team that says that something's going to happen or to expect something that never occurs. I think you just have to have a short leash for people that do a lot of talking and not executing. And so I think that's definitely an area that I've gotten less and less patient with. And I think it also reflects down into your portfolio sizing, and that's an area we can talk about later as well. Averaging down into things, and that can be a mistake as well. But for me, I definitely have a shorter leash than I used to. There's plenty of opportunities out there. The key to investing is staying in your winners and cutting your losers. And winners, tend to keep executing for a reason. It's because they're good management teams. They're taking advantage of a market opportunity, whatever they're doing. And, I would just rather be in things that are winning instead of companies that are just keep on making excuses.
For sure. So my next question is, because again, you full-time private investor since 2008, but really in microcaps since the late 90s. Where do you draw the line in attaining information that you need to make an investment decision? There's been so many new tools and resources being put out there on almost seemingly a daily basis. For you, where do you then draw that line?
It's a great topic, and I don't know if you ever read any of the research done by Paul Slovic, but anyway, he did a study in 1974. He was a psychologist. He was a peer of Daniel Kahneman, so he kind of rubbed shoulders with him. Really smart guy, and he did the study where he gathered 8 professional horse handicappers, and these handicappers were all seasoned. They were professionals. They all made their living solely from their gambling skills. And Slovak told them the test would consist of really predicting 40 horse races in 4 consecutive rounds. And each one of these horse handicappers in the first round, he would let them choose 5 pieces of information. They could choose whatever 5 they wanted. And in the second round, they got, I believe, 20 pieces of information, or no, it was 10 pieces. And then the third round, 20. And then the fourth round, all 40 pieces of information. So that they got more and more information. And what was interesting was after the first round, so each horse handicapper got the 5 pieces of information they wanted, the first 5, their accuracy went up by 17% in their ability to pick the winners of the horse races. In the subsequent rounds, when they got more information, they didn't get any better. They didn't get any better, but their confidence went up 2 or 3x, which led them to want to place bigger bets, even though they really weren't any more accurate. So that it actually ultimately ended up with them losing money, And I think that study is interesting because it can show how dangerous and the difference between accuracy and confidence when it comes to investing as well. So when you think about that study and apply it to investing, when you think about those horse handicappers, in the first round of that study, when the horse bettors were asked what 5 pieces of information they wanted, I can guarantee you that those first 5 pieces of information were the ones that were most important to them out of all those 40 that they could have asked for. And, I think it just shows that kind of to pay attention to the 4 or 5 things that are important to you as an investor and not get stuck into a lot of the details that you can kind of get into looking at all the minutia about everything. Mm-hmm. So I think it's important to keep it simple. For me, when I look at something, I really kind of apply sort of 4 filters, if you want to call it that, for the way I invest, and it's going to be different for each person. But really when I'm looking at a business, I'm looking for an organization that's showing signs of kind of intelligent fanaticism. A leader that, owns a good piece of the company, has a reasonable salary. When you go visit the company, the employees, tend to look like they like working there. You talk to the employees and there seems to be a good culture there. Just a good operator. The second thing I look for is a business that can grow through a recession. Especially now that we're in a 10-year sort of bull market, obviously every day that goes by, we're closer to perhaps a recession. And I think it's becoming more important to, think about that and think about what you own and making sure you're in businesses that can continue to do well in a neutral to bear market environment. Mm-hmm. So that's kind of the second filter. And, the third filter is really having a balance sheet that can weather the storm, in a bad market. So they can act with boldness and maybe acquire a competitor or buy back stock, or whatever the case may be. And then the last but not least, I think is, for me, when I look at any investment now, I look at the opportunity as, do I think I can double my money in 3 years? Based on conservative fundamental underpinnings, do I think the stock can double in 3 years? And so that, that's a 25% CAGR. Doesn't mean I'm going to be right, but that's sort of the lens that I look at every investment opportunity in. And that gets back to what you're paying, the price of that equity. So that's how I kind of just hone in on what's important. And I try not to get distracted by a lot of details that make me feel like I'm getting more confident, but I'm not going to get more accurate.
Listen, there's only so many video interviews you can watch me do with the CEOs you might be interested in investing in. So I get it.
Yeah.
I understand. So, what would you say has been your biggest mistake? In your investing career. I mean, you tell me if you want to go full on investing career or since
there's been plenty of those. Period. You might have to do a separate podcast just for my mistakes.
Let's do it.
Let me think about it. I'm trying to think which one or which area. Now I don't know, a few areas. what I found is like successful investing, it's sort of 5% intellect, 95% temperament. And a lot of things can influence your temperament outside of even just the market conditions. I mean, the stock market or the stocks themselves going up or down. Things like we talked about before, like position sizing. I think it was Steve Burns who was on Twitter. I don't know if you follow Steve; he's great. Mm-hmm. But he said that said something to the effect of the larger your position size, the louder your emotions become.
Yeah,
and I think there's a lot of truth to that. And I think so when we're talking about position sizing, I sort of divide position sizing, even that topic, into two camps. What do you make your position size at cost when you initially like something? How much are you willing to buy at cost, a percentage of your portfolio or allocation? And it's really a question of investment at cost, not as a percentage of your portfolio, but the real dollars you then deploy into that idea. Meaning you might make a position a 10% position, but if the stock drops 20%, you continue to make it a 10% position, you're averaging down. And so you're still deploying capital into that idea, even though it's still the same allocation. So there's some difference there, and I'm getting down the weeds a little bit. I apologize.
Let's go. It's all good.
But I think so I've made mistakes in the past averaging down into positions and just deploying too much capital into them, even though the position size allocated percentage-wise was the same, but I just, kept the allocation size the same. And it's much healthier to let a position get bigger by it appreciating in value rather than you just deploying more capital into it. And so it's another thing I'm just more conscious about. So that's one area of my mistakes, letting a position get bigger through that stock getting appreciating rather than me just deploying more capital into it, maybe while it drops. I'd much rather be adding to things that are going up, believe it or not, which is counterintuitive. But, another area, when I think about it, related to focusing it's kind of related to focusing too little or too much on your investments, kind of gets to the topic we were just talking about before as well. I believe there's a real art in focusing on what you own and focusing on your investments. I've gone through periods where I got really lax with my maintenance due diligence on positions, and that cost me a lot of money. I used this analogy before, but and we used it earlier in this podcast about 3-year-old children. You can't leave them alone in your house alone, or else they're going to burn your house down. You need to watch them. But on the other extreme is focusing on your positions too much, focusing on that minutia of information we talked about before can be really harmful too. It's like when you're staring at your positions and the stock prices constantly. It's like you're staring at a dude hitting on your wife or something like that. Just angrily looking at that isn't healthy either. You need to focus on the things that are important. Those business levers, those tailwinds. Execution. Don't micromanage every little thing about what you own. Focus on the big things. It's like, do you know what what's the name of those pictures or puzzles? Autostereogram. You know what those are? Mm-mm. It's those pictures or illusions that people have up on the wall. That
okay,
yeah. It's like, and you have to stare at the whole picture. You can't just stare at a specific area or corner. And really, to see the illusion, you kind of have to stare at the entire picture with unfocused eyes. And I feel like successful investing can be a little bit like that. You kind of have to look at the whole picture. You can't really focus too much on the intricate little details, kind of stare at it with unfocused eyes, a little bit. And so you can see the whole picture.
Well, would you say that's only after you've done your due diligence and maybe even taken, then like, okay, all right, I got into the weeds.
Yeah, I'm talking about maintenance due diligence.
Yes.
Yeah,
okay.
Yeah. And so those are kind of two big mistakes. I'm trying to think of any more. I think probably another area where I've made a lot of mistakes is just my expectations. With almost, I think, all of our positions as investors, we have too high of expectations going into it. Expectations for the growth rate, expectations for the timing of things to occur, the catalysts, and expectations probably with the linearity of execution from the management teams themselves. And so I think it's important for the models that we create to be very conservative. This way you can give your positions enough wiggle room to breathe a little bit, allow for a little disappointment, allow them to exceed your expectations. And so I think expectations is another area where I've made mistakes, where I've gone into things pretty consistently with expectations that are too high, and it's just you're setting yourself up for disappointment. And I'm trying to think if there's anything. Maybe one other area is, the bad thing about investing in mistakes is mistakes tend to compound other mistakes. So it's sort of like the great thing about compounding capital is the compounding effect of that capital, but you can compound mistakes as well. And, oftentimes when you have lost money, you get really, really impatient and you want to make back that money twice as quick and start compounding those past errors. And so it's important to always kind of slow down after a big win or a big loss. And, kind of getting back, I know for me in the past, I've just had to slow down and be like, okay, even if I was down 40% in something, is this something where I believe I can double my money in 3 years, getting back to that point? I don't need to make back 500% in the next 6 months.
Right.
Is this something that still fits that longer term lens?
Got it.
So that's probably another big area where I made mistakes in the past. So I don't know if that's helpful or not.
Oh, definitely. I mean, especially speaking to the last mistake that you made, I feel like that's been like my number one of like, especially on my losers where, if I lost, I'm like, all right, just either actually it's a combination of that one with the cost averaging down of just like, oh, I still believe in this. I'm put more in, oh, I love it now. It's cheaper. Actually, that was one of the things I wanted to follow up on in terms of your mistakes, because you hear that all the time. I've done, a number of interviews with people where they're like, hey, if you loved it at $2, you're going to love it at, $1.50 or $1, and especially if nothing's changed, so for you, especially when maybe there might be a downturn, and usually everyone always says that, most people tend to sell off their more riskier investments, and yet nothing's really changed to the underlying business. At what point, how do you balance that? If that makes sense. I can re-ask that question if that didn't make sense.
No, I think I know what you're getting at, because I'm not saying buying the stock lower is an awful thing to do.
No, I know, but I figured like, there's still that balance though of not always having that same reaction, maybe where if it goes down there versus when it goes down when nothing really happened in the business. It was more of an overall market change versus something, a material change in the company.
Yeah, exactly. I mean, if a business, and so the difference between focusing on the stock versus the business, if the business is performing and doing well, and you're just having a negative market reaction that might be even outside the company's control, it's a market type downturn. Yeah, obviously those are times to add to a position. It's when you get stuck trying to fool yourself into thinking that, okay, the catalyst is another 3 months off. It's another 3 months off. It's another 3 months off, and you keep on just adding more into it as it drops. Just pay attention to the business. Make sure you're investing in things that are executing. That's the main thing, and focus on the business, not the stock.
Mm-hmm. Hey, another question I have too is, you mentioned earlier how you're already very concentrated, but you've diversified from, your 3 to 5 to now you're 8 to 10. And some of the new ideas that you've brought into the portfolio are these, story stocks and storks stocks and and GARP names, and that tends to usually be associated with, especially in microcaps, your junior mining, your healthcare kind of stuff, biotechy pre-revenue type stuff, and one thing that we've covered a lot too on the podcast and in other interviews I've done is this idea of, wanting to stay within your circle of competence. For you, I mean, at what point do you become confident that your competence can ultimately yield some positive results on some of these names?
Right. Well, I mean, getting back on the story stock thing, I don't want to say that I'm investing a lot of. There's plenty of story stocks out there, as you and I both believe. But maybe what would be helpful, I'll kind of divide it up, kind of how the strategy looks like today. I divide things up into 3 buckets, and the first bucket is sort of good to great businesses, and these are businesses I think are unique, that are special, that can grow, reinvest their capital back into the business. They don't need to raise capital. And, you can find these special businesses in microcap, that dominate these niche areas that are expanding. And that predominantly makes up that first bucket. The second bucket is more of a turnaround bucket. It looks a lot like deep value or value when you look at them, and you're trying to find these sort of deep value type situations that could potentially turn into a growth company again. And usually you can kind of pinpoint when a new management team comes in, starts selling off non-core assets, focuses on an area that they do have a competitive advantage in. And you can just make a lot of good money just investing things like that if you can get that correct situation that goes from a deep value price to a growth price, something that trades on a ratio to its balance sheet to a multiple to its earnings. And you can make multiples in your money if you find those types of situations. So that's the second bucket. The third bucket is sort of the rocket ship bucket. It's sort of the story stock bucket. It's sort of those things that you think could have 20, 30x potential in a few years. And as you know, Bobby, being in this ecosystem, every company thinks they have that potential.
Sure.
But a lot of them are also zeros, if you're wrong at all. And I'm not interested in having zeros. What I'm mainly talking about with the story stock or the rocket ship bucket is trying to find those companies that have a legacy business or a core asset that also has some things that they're working on that could provide some exponential upside there. And hopefully you're buying that stock close to that underlying floor of value to where you're not risking that much, so you might be willing to risk 30, 40% of the downside, if you're wrong, for that upside. But, I just didn't want people to think that I'm just out there buying, story stock, like you said. So there's a little bit of a formula to it. So, and I also wanted to give you a little bit more feedback on how I view the portfolio construction. It's kind of in those three buckets. And a lot of times the rocket ship bucket, their position size smaller than the other ones as well. But all it takes is kind of 1 out of 3 or 1 out of 4 to sort of take the whole portfolio with it.
Hey, as you said I think it was on Twitter and on LinkedIn, it only takes one to make your career. So,
yeah,
whether it's in one or maybe has attributes in multiple buckets, it only takes one.
Yes. Yeah. Yep. No, exactly. And I'm sitting here because, I had a few of those early in my career that allowed me to compound at a higher rate. And, so anyway, I just wanted to give you some feedback just on those 3 areas, those 3 buckets that I currently invest in.
Gotcha. And by the way, we've already beat our time on the first interview. So I think we're both evolving in the sense that I think we have more knowledge to continue to give. So let's keep going. All right.
Sure.
So my next question is, and this is a fun one, is, again, you've been doing this a while. You've actually hosted a few conferences as well. What would you say is your favorite question that you either ask investors and also that's been asked of you?
I think my favorite questions to ask, and there's a few of them. I love to ask an investor what they're buying at the current price. Because a lot of times if you ask an investor what they like most, it's going to be the thing they're up the most in. And so I kind of want to know what they're buying, at the current price. I also like to ask them what they're selling or what they've sold. And what's the last stock you sold in the portfolio? Because I think that you can learn some interesting things there with that one as well. I like asking people when I'm talking to an investor what their strengths and weaknesses are, because I think we all as investors have holes, areas that we're better at or not good at. I think it's important to be self-aware of what those areas are so you can fill those voids. And I'm always interested in what people think that their strengths and weaknesses are. And maybe the last one, kind of hitting back on maybe some of the areas that we talked about in this podcast is, how has your investing evolved over the last 5 years? I think it's important for people to not be investing the same way they did 5 years ago. It doesn't mean they have to be investing totally different. It just means what areas on the fringes have you tweaked, that you're doing differently, or maybe some areas that you completely changed your mind on. I think that's also interesting to know when you're talking to an investor. So it's kind of maybe those 3 or 4 questions.
What about your favorite question, or maybe how about favorite and silliest question that you've been asked now over the years? I mean, you're whether you like it or not, you're viewed as a thought leader in the space now. So I'm sure you've gotten all sorts of interesting, weird questions and comments.
I don't know if it's been weird.
Other than what you own, I'm sure that one is probably the number one.
I probably one of my favorite questions is a little bit deeper than that. It's more of, what's been a point in your life that you've felt the most vulnerable? That kind of hits on deeper than just investing.
Of course.
I think I just asked Toby that on the interview I did with him because I was curious, where was there a point in your life where you were close to a breaking point, and how did you get through it? I think that's something, an area that people can learn from, overall. So I think that's a thoughtful question that I like to ask people. Get to know them a little bit better too.
Cool. Yeah. I'd like to think I've asked a couple good questions to you over the years. Listen, I know you sometimes get those random emails from me like, dude, what do you think of this idea? So I hope you'll continue to indulge me in some of those.
No, absolutely.
And for those who are listening, I just put my hands in the air of just my nutty ideas. But anyways, I digress. So I mentioned earlier, you've now hosted a few of these microcap leadership summits. I think I've been to three out of the four. Yeah, I think 3 out of 4 of them, the ones in Chicago. There was also the famous Detroit one, of course. I missed that one, but it's okay. Let's talk about the summit. How did it go this year? What were some of the feedback that you got?
I thought the summit went really well. The nice thing about having it at the same location, as you know, with your event, Bobby, is it just gets easier if you have it at the same location because you know where those breaking points could be, if something goes wrong. But no, I thought this year went really well. We had a great lineup of speakers.
Oh, yeah.
And I was really excited to hear what they had to say and to learn from them. And I think everybody enjoyed those speakers as well. Probably the area of the event that I like the most is trying to find the best speakers I could find, for that day one. And really trying to find folks that could add value to the investors sitting there, and also people that have a wider audience beyond just microcap as well. Because I think it's important to bring quality investors into the microcap arena. So we can continue to attract really good thought leaders to come speak at our event. It brings people from all over the world to it and introduce them to microcap investing. And so that's what it's sort of what gets me going. And that's what gets me excited about the event every year. And I'm excited about the speakers we have for next year's event, which we'll be announcing probably mid-November registration. So it's good.
Damn. We're recording this on Friday, November 8th. We're going to be breaking news next week.
Yeah. Damn. I think people will be excited about the speaker lineup we have for the Summit 2020. So.
I love it.
And I appreciate you coming out, Bobby, too. One of the things that Bobby is a workhorse at every event because he's forced to work and do all these interviews. And the one thing with Bobby coming out with our event, I said, Bobby, I don't want you interviewing anybody. I want you to enjoy the event, to sit there as a participant and actually enjoy something for once. And I'm glad you're able to participate in ours as an investor in the audience as well.
I can't tell you how appreciative I am, but I will say we broke that rule this year. I did do one interview at the event, but it was
That's right. You did Rohit. Yeah.
But that was so awesome. I mean, he was pretty amazing. His story is incredible. And probably one of the most humble people ever.
Yeah, he's great. He really is.
So, one of the things that stood out to me, as you said, I actually got to sit and enjoy and listen to a lot of the presentations and all these speakers do their thing. Some of my highlights was Morgan Housel's discussion of risk. I thought that was really incredible. Sarab's thoughts on short-termism, culture, and the importance of culture and activism. I think I love the coining of the phrase friendlyivist.
Yes, yeah.
That was so good. So good. We might discuss it in a second, but I digress. And then of course Jim O'Shaughnessy just talking about discussing microcaps with colleagues and really just understanding human nature, and how nothing's really, his main thesis is really nothing's changed in terms of our human nature over the years. It's just a matter of being aware of it and then making sure that you take actions based on that. And a lot of what you said on this podcast today is, the difficulty in staying objective with positions. So those are some of my highlights from.
I remember Morgan during the interview at the summit, and I never knew this about him, and I've talked to him many times. It was about his experience when he was on the ski slope, because he was an active skier, and where he and a friend, I guess they were off the main trails, and he and his friend went one way, and his other two friends went the other way. And those two friends got killed in an avalanche, just minutes later, and so I think that was a pretty impactful story that he shared. And also I think one of his points was, it's probably why he looks at risk differently, where he's a rather risk averse person because of that experience earlier in his life. And I thought that was a really good story that he shared with us.
Yeah, no, I wrote down the quote that he actually said it. And it was basically something along the lines of that, you really can understand each person has a different level of risk based on their own personal experience, whether it's investing, actual personal stuff, so it's really difficult to kind of paint it with a broad stroke of how do you calculate risk, because it's very personalized. you know?
Exactly.
Yeah.
Yeah.
So I love that. I can't wait for 2020. Do we have dates yet?
It's going to be, I think, September 24th, 25th
Okay.
of 2020.
Okay,
Yeah.
there we go. Breaking news there. September 24th,
Yeah,
25th,
it is.
2020.
I'll give you that one.
All right. One more question I had for you. Well, I have two more questions, but this one's also a fun one. You know, I'd say a lot of people, you know, who follow you on Twitter and LinkedIn, you know, you put out some pretty amazing quotes. You know, part one. Where do these quotes come from? You know, I mean, I'm assuming from your own brain, of course. You know, but secondly, if you had to compare yourself to one philosopher, non-financial, in the history of time, who would it be?
So when it comes to Twitter, it's for some reasons I just connect with it. I like taking big complex things and distilling it down to 280 characters. It used to be 140 characters back in the day, way back in the day. I'm sure you remember those days.
Oh,
yeah, yeah. And I find it to be very useful in my writing because I can distill a thought down, people connect with it, and a lot of times that becomes a staging point to write an article. Because I see it connects with people, and it's something that usually if it connects with people, it's something that I should think about a little bit more. And so I'll write a little bit of a longer form piece on it. And so it's been really good for my writing as well. And, you know, I think, I just enjoy it. You know, I try to not let it kind of take over. You know, believe it or not, I don't spend too much time thinking about what I'm going to, I need to put out a tweet right now. You know, it's more of, you know, my investing comes first. And when I'm just thinking about investing, I jot down something and tweet it out. You know, I don't schedule my tweets in advance, you know, the start of every day. You know what I mean? It's like, I don't do it like that. It's just
these are not your mantras for the day. This just happens to be
your thing. Yeah. These aren't scheduled. It's just kind of random. It's out there. And I'm happy that people connect with it and people find value out of it.
I have to ask because I do that, and I think, you know, I've talked to some other investors, you know, who also follow you, and we're all just like, where the hell does he come up with this stuff? You know, it's all so good, and we all connect with it. So that's why I was like, all right, you know, I had to ask.
Yeah, and on your second question, I have no idea what the philosopher. Who would you think?
I mean, it would be somebody more postmodern, I would say, because you're very much not about, you know, getting the 100% perfection, because you also acknowledge that that's impossible. So I'd say you'd probably go along the line. I mean, of the postmodern philosophers I've read, you know, close to that. I don't want to say a name because I haven't read all of his stuff, but just from what I've read, you know, on his idea of that, you know, your goal in life is it's really all about the journey, not so much the end game, you know. And so I won't name his name, but that's more or less.
Well, I think investing kind of reflects back into life. It's about adapting. You know, it's about adapting to change, about adapting to your environment. You know, and I think that's important with investing as well. You know, investing isn't a game of batting average. I'm never going to be right 10 out of 10. I'm probably not going to be right 8 out of 10. You know, I can be right even 4 out of 10 times and still do very, very well if you kind of get rid of the things that aren't working in the portfolio and reestablish new things in there, you know, and just letting the things that are working in your life continue to work, or investing, you know, things that are working in the portfolio continue to work as well.
Yeah. No, that's, and, you know, in your most recent article about chasing, you know, like I emailed you about this too, is, you know, my reflection on that for me was, you know, not so much what's chasing me, but what I'm chasing, you know, like, cause at first I kept thinking to myself, like, what are the things that are chasing me? Like, you know, going from all my insecurities to this, that, the other thing, like what's chasing? But I realized, no, I don't think that was the point, at least for me, for that article. Right. It was really, well, what am I going after? And becoming more aware of how getting to that is the fun. And that's the living, you know, and that was what I took away from that one.
Well, and the older you get, the less it becomes about you. You know, more becomes about, you know, your family. You know, just wanting to do well in this world. You know, and be a good influence on people around you. So,
yeah, no, I'll definitely.
I'm glad you connected with it.
Yeah, no, I really enjoyed that one. Okay, my last question. You know, and what would you say are some existential threats to the microcap universe, both for you as a full-time investor and also just our arena in general?
I would say an existential threat is what's been occurring in the US microcap arena for years, which is just getting harder and harder for companies to raise capital as a US microcap and go public. And it's getting harder for investors to also participate in fundings for small microcap companies, because not many of the brokerage accounts or brokerages out there even accept stock certificates anymore of small microcap companies. And so that, again, just freezes up the capital markets for small microcaps. And also the brokers themselves, a lot of them won't even allow you to purchase, a penny stock anymore. And so you would think that the pendulum has swung far enough in one direction, and I'm hoping it starts swinging back the other way again. And I think it's also another reason why it's becoming more and more important for a microcap investor to have more of a worldwide view, to not be stuck in your own geography or location. Luckily we can invest in Canada, we can invest in UK. Open up an interactive broker's account and buy a security in any market in the world, and so you have that capability. And so you have to be able to adapt, kind of what we were talking about before, and move into some geographies that these companies can still raise capital. They're still good companies going public, and you have to be able to move into those areas. So I think that would probably, the way the U.S. is right now, is pretty bad. It seems like it's still getting worse. So I just hope that changes.
Okay. All right. One more question. I promise. This is the last one. So what would you say since July 2015 has been your biggest learning experience, from an investment, not personally, but just from an investing experience? What would you say you've learned the most from? You don't have to name the name.
I think we hit on it before, just having a shorter leash. There was an investment of mine that was a rather large holding that, I just held on and held on. It was 4 or 5 years where, the stock really went nowhere. I didn't really lose much money. And in fact, I think I still made a little bit because I bought it fairly early. But, it's hard to sit on a position that goes nowhere for 5 years, especially in one of the biggest bull markets in history. And it really, came back to, I probably got caught too much in the details and the weeds, and got a little bit too close to the situation, where if I just took a step away and saw it for what the situation was, I should have probably exited a few years prior, moved on to something else. So I would say that's probably the biggest area in the last 5 years I've evolved.
Gotcha. All right, Ian, we're at that point. Where can my audience go and find more information about you, MicroCap Club, and follow you on social media?
So you can find out about MicroCap Club at microcapclub.com. You can find me on Twitter. I'm at Ian Cassel is my Twitter handle. You can find MicroCap Club on Twitter as well, or you can just reach out to me through the websites. I try to get back to people if they email me. So thanks for having me on, Bobby.
Oh, absolutely. One more plug for IFCM.
Yes, and Intelligent Fanatics Capital Management up and running. Just if.capital is the website.
Got it. All right. Ian, thank you as always, man. I really do appreciate it.
Thank you.
All right.
Thanks, Bobby.
You're welcome.